The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN Monday morning, just after 9 a.m. Eastern Time. We got about 24 minutes to go until the start of trading. And you have a pretty mixed market. Calm market this morning as we come into some inflation data for the CPI on Wednesday. We got PPI data on Thursday. Quite the acceleration on the jobs number on Friday, man. Two accelerations, right? You got the first one right out of the gate from 8:30 until about 10:30 Eastern Time at 41.40. You retraced about 10 points, and then you took off again to 41.60. You closed out the session at about 41.50. Right now, 5 points higher in the pre-market in the S&Ps. NASDAQ 100, we make it above 13,350 on Friday's session. We're trading just marginally lower, off about 0.1% right now, trading at 13,298. Dow positive by 67 points this morning. You get the Russell up by 0.4%. How about 70 points from where this thing was trading at on Thursday? What is that? More than a 4% pop from Thursday's lows in this market. And where do you come back to in the Russell? Right where you were on Wednesday, on Fed Day. Crude continuing to catch a bid. You talk about lows last week. We spiked to $63 and change. We're at $73 and change. Crude up $1.84 this morning. You got some action in Bitcoin as well. How about Bitcoin down $2,000? What was it? Binance pausing withdrawals, I believe. Never good when you hear that, man. We talked about crude. Gold contract up a bit after falling off on Friday. Gold up $5 right now at $20.30. And we jumped in notes and bonds. We're getting some lower price and some higher yield. The 10-year off 14 ticks at 115.09. The 30-year off 27 ticks. You jump over to the VIX Volatility Index this morning. Quite the pullback last week as this market, what were we up, 73 points, something like that in the S&P. On a pretty hot jobs number, wages up 0.5% month over month. Nonetheless, the market plows higher. You finish the session at about 17.59. At about 17. We're trading right now at 17.59 in the VIX. Okay, what are we going to talk about? We're going to talk about some Federal Reserve and some inflation. Why not? Article out here this weekend. When was that dated? Yeah, Saturday night it looks like. I think I was reading it yesterday. Fed's about to find out if it can afford to pause rates. Now, what they mentioned here is we're going to get 2 months of data. Interesting, right? We're going to get all the May data before the June meeting as well, okay? Annual U.S. core inflation, that's what we're talking about this week. When you see this chart, folks, just pay attention, man, okay? Because, yes, we could be on our way to 2%. This is the core CPI. Okay, so we're going to see some headline numbers that might be attractive, not if crude continues what it's doing right now, going from $63 to $73 in a week or a few days. But nonetheless, don't get caught up in the headline numbers because the battle is going to be on if core gets sticky above 5%, right? Remarkable. Now, just as a technician, you got a double top here, okay? And if you pull back, though, you're still talking about being at 4. They have a long way to go, man. You look at that chart, the red is the estimate that we're going to get on Wednesday for April. You're talking about 5.5%. What happened do you remember all the talk that we were going to come into some very attractive comps as we come into the spring, the summer? We're there, man, and we're still crushing 5.5% on the core. We've been sticky. We'll find out Wednesday in terms of that number. But central bankers on May 3rd raised their benchmark interest rate a 0.25 point. That was the Fed, of course. Now we get to see if they pause. Aside from the CPI, we get PPI on Thursday. Economists project affirming in cost pressures for April compared with a month earlier. It's going to be important to see where the data goes. That's for sure, folks. Now, we'll go into the break. And I have a great piece. Is this the one? Yeah, it is. Yeah, John Authors. I just enjoy a lot of what he talks about in these. We're going to talk about this. Been hedging around the pivot. Don't stop now. That'll be the teaser. We'll talk about that one a little bit later in the program. All right. Let's talk a little banks. You got the Russell up 7 points, right? We got PacWest. I mean, some of these numbers, man, from the lows last week. I don't know, folks. I don't know if I'd be the one buying PacWest at $8, man, because did you see the core inflation numbers at 5.5%? The Fed would love to let off on the gas pedal and give these banks a break so that they weren't having to have banks getting seized by the FDIC on a constant basis right now. But they can't as long as core inflation stuck above 5%. Core inflation stuck above 5%. It sounds crazy to even think, but nonetheless, those are the numbers. And yes, the Fed could pause, but now it shifts to how many cuts they have priced in. And that's what we're going to talk about on some of those numbers. But nonetheless, PacWest, what, $2 it's almost up in the pre-market? Western Alliance up another $4 from $27. Almost all these getting everything they got back from the Wednesday collapse. Not sure it's that simple, man. Some of the numbers they come out with earnings, strong numbers, contrary to the banks that have failed. But that volatility is going to continue, and the pressure on the banks is going to continue, man. I mean, we'll go over some of what Buffett talked about this weekend too with their annual conference, and it's going to be a battle because consumers have woken up to the idea, man, that there is an alternative. The dollar is an asset class. It earns a yield. Dollars stored at banks, they weren't earning anything for a long time, and now as a consumer, we've all woken up, I think, to the fact that, folks, and I'll pull up the yields as well. I was talking to my dad. I mean, in the market, if you weren't looking at CD rates, you wouldn't realize that, the 10 years at 3.5%, all right, and we'll pull up the Treasury yields after the break maybe, but CD rates are 5%, man. On a 2-year, you're getting more than 5%. This was as of Friday, I think, okay? They're probably even a little bit higher today. More than 5% on a 2-year, and I think if you ladder out a 5-year, you're getting something like 4.92. Staggering returns, okay, for people who have money in bank accounts and aren't there. So I'd be careful of this banking sector, man, because be aware that sometimes there might be more going on than you know, and that chart looks like there might be more going on than you know. Speaking of, let's jump to Bitcoin, man, because these headlines are always interesting in light of you really never know what's going on in Bitcoin. And Bitcoin, Binance restarts withdrawals of Bitcoin after a second halt. Withdrawals of the token were paused twice in less than 12 hours. Yeah, and that will put crypto markets on the back foot when you can't take your money out of an exchange, right? Restarted with withdrawals, 2 halts in less than 12 hours. The company said higher fees have been applied to pending transactions so they get picked up by the Bitcoin miners, the computer rigs that operate. So they were saying they weren't paying the fees. To prevent similar recurrence in the future, our fees have been adjusted. We'll continue to monitor on-chain activity. They halted withdrawals on Sunday earlier for 90 minutes, blaming congestion on the token's blockchain. And it had to do with fees. They're the largest exchange in the digital asset sector following the collapse of FTX. So they're the biggest one out there, and even they will pause withdrawals. So be careful, man. I saw a report on Bloomberg, I believe, this morning, and here's where they talk about the fees. The withdrawal fees charged by the exchanges fell short of the fees charged by miners. So there was a queue of transactions pending verification for inclusion in the blockchain has experienced significant growth in recent days, causing an increase in transaction fees and confirmation times. But how about this one? Binance on Sunday also moved $4.4 billion worth of Bitcoins across its digital asset wallets. The exchange said in a tweet that Bitcoin was moved between Binance hot and cold wallets due to Bitcoin address adjustments. We'll see if that's the reality, right? Stay tuned, folks. We're coming back. A lot to talk about this Monday. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no cash or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We got the S&P right now trading at 41.54. Market's basically flat. The S&P was up to about 41.60, kind of the highs that we had on Friday. This 4,200 point is an interesting one, folks. And where did we get to on Friday? So just putting this thing on a 10-minute. You closed out the session somewhat near the 618. Now, you almost made it right up to the 786, right? Really what you did was you got up to the highs of Wednesday before the market pulled back on Chairman Powell, the Federal Reserve, in the news conference. 41.60 is the price point that we kind of oscillated around towards the highs of Wednesday. But boy, 4,200 on this chart. We're only 40 points away from there. We still got some earnings this week to come, not to mention inflation data on Wednesday, PPI data on Thursday. And so jump into this article. Now, this is an opinion piece, correct? Yes, it is. It's an opinion piece, okay? But some of the data in here is really what I want to focus on. And that's not opinion. That's just straight data. You can build your opinion from that data. And what he talks about here is been hedging around the pivot. Don't stop now. Whatever the recessionary indicators may show, and this is his opinion. It's not really the part that I want to bring up to give credit to. Okay, I'm giving credit to some of the data we'll go over here. But the purpose of this is there are strong reasons against expecting an implied flurry of rate cuts. Okay, whatever the recessionary indicators may show. Okay. Now, what he talks about in here, it's a very long article, which is why I keep pausing to try and figure out what I want to focus on as I go through it, okay? Check it out. I'll post this in the Tiger's Den. I post a few. It's a long one. He even gets into the king down there, okay? But nonetheless, it can't carry on like this much longer, right? We know that corporate America is in much better shape than many had thought. Tech earnings were pretty good, man. You cannot deny that. Amazon, AWS, like the only downfall of the big FANG stocks, I would say. And even there, like I talked about last week, if you didn't see the segment, folks, seller services and advertising on Amazon, those two combined are doing almost $40 billion, and they're growing at almost 20%. And meanwhile, AWS is at $21 billion and growing at like 11 to 16%, somewhere in there. So it's surprising that advertising and seller services, this is from someone who owns Amazon retirement account and is an Amazon bull, but it was surprising when you break down those numbers that AWS gets all the attention. They're doing about $21 billion in the quarter and growing at 11 to 16%. Meanwhile, Amazon has created seller services and advertising. I think advertising's doing like $10 billion, seller services doing like $29 billion, something like that. Both of those areas growing between 18 and 21%. So if the only downfall of the tech week was Amazon's AWS earnings and it comes with everything else, pretty good week of earnings for that. But the labor market remains healthy, and yet confidence with which bond markets are now betting that the Federal Reserve must pivot and do so imminently has never been greater. This is one of the most profound things to think about in the market right now. The Fed changed the language dramatically, and we're talking a little bit of big picture. We got 9 minutes to go until the opening bell. We get CPI data on Wednesday. We get PPI on Thursday. We'll go over some of the technical factors of the charts. We'll go over some of the other news stories this morning. You got Tyson out there talking about people are paring back the amount of money they're spending on buying chicken. But right now, the Fed looks that they are going to pause at some point. The rates are pretty astounding that they're at. You could make the case that inflation is abating a bit while it's remaining sticky for longer, but maybe they ride things out for a year or two, okay? You can make a real legitimate case, man, that you could pause now, and we are restrictive enough that eventually we'll get back to 2%. Now, people would make the argument that, hey, you can't let inflation just go. You got to squash it, right? That's a legitimate argument as well. Fed's a little worried that they're going to squash it too harshly as we have banks failing everywhere, and you're seeing stresses on the system already. So I imagine that they will pause at some point soon, whether it's this meeting or the next. These inflation data points are really going to matter if we get a big surprise. But I think the more profound question right now is, how do you price in cuts? And what does that mean to the economy? What is that going to do? What does that even mean for stocks if we're cutting? Are things so dire that when the Fed starts to cut, that's not going to save things? I'm not so sure, man. The market's going to be jubilant the moment we get a cut, because that means there's probably more coming. Right? Probably not going to be jubilant leading up to that, because it'll take some harsh situations for the Fed to think about cutting where inflation is. To get to the facts, the Fed funds futures now price a likelihood that over the next 6 meetings, okay, now the Fed meets every about 6 weeks. So 6 meetings, 6 weeks, you're talking about 36 weeks, you're talking about 9 months, okay? Over the next 9 months, over the next 6 meetings, from now until January, is that right? No, 7 months then, I guess. We'll see the equivalent of 5 cuts. I think that's bonkers, folks. Now, it's not bonkers if we find out banks are in a lot more trouble than we thought. Their balance sheets aren't as strong as they thought. Maybe we find out that, guess what? They really have to fight for this money. They have to raise CD rates. They can't make any money even with the money they have, right? So there could be stresses on the system. 5 25-point cuts. To back it up, folks, the reason why that's so astounding as well is because of this chart that I started off the program with. I mean, folks, this is the April estimate. That's talking about January of next year, and you're talking about 5 cuts, and this is the core CPI. Look at this chart and realize how quick of an acceleration it would have to take for 7 months of data to bring us back to an area that the Fed is cutting 5 times by then. That's astounding, okay? The last part of this conversation, okay, this is based on various assumptions, but the idea that inflation will come under control very swiftly is critical to them, okay? Now, we all have opinions. This is one of the most important opinions you can have in the market, probably, about what's going to happen to inflation over the next 6 to 9 months, because you just see it there. The market's pricing in 5 cuts over the next 7 months, man. We don't have forever, okay? We're in the summer trading. That's going to make things interesting as well. But check out this last part that I love from this article, which is really why I said I got to talk about this, man. The 2-year inflation break even, okay? You learn so much in the market, folks. Experience is nothing like experience, because who was focusing on the 2-year inflation break even? Well, there were a lot of people in in Wall Street, focusing on that, the brightest of the bright, of course, as in that's a pretty analytical stat, right? The 2-year inflation break even, it's so important right now, though. Derived from the difference between inflation-protected and fixed-income bonds, suggests that inflation will average almost exactly 2% into the first half of 2025. That's less than 2 years away, folks. That's about a year and a half, okay? That is right after we get a presidential election coming up late next year, which is bonkers that's how quick that is coming. Here's the kicker, though. It's worth remembering that the break-evens can be wrong, particularly in the bizarre conditions created by the pandemic, which have made fools of us all. I would agree with that, especially some of the analyst numbers. Do you remember when analyst numbers were just off? Like every single earnings, every single number just dramatically off during the pandemic? The chart below shows the 2-year break even and the actual consumer price inflation number with a 2-year lag. So what it's showing you is at each point it compares the bond market prediction with the actual outcome, okay? So you have the blue is the prediction, and then you have the black 2 years later compared to the same time, the actual inflation break even, the actual inflation. You have the 2-year inflation break even predicted on the bottom in blue, and you have the CPI 2 years later. And what it remarkably shows is that 2 years out, okay, and they sum it up better than I'm going to say it. This chart shows the 2-year break even and the actual consumer price inflation with the 2-year lag. The peak in inflation above 9% came almost exactly 2 years after break even suggested that there would be an outright deflation. So we hit peak inflation. 2 years after break even said we were going to deflate. We'll finish this conversation up. We're coming back for the open, folks. Stay tuned.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. You got an S&P up by 5 points, trading at 41.55 right now. NASDAQ 100 barely in the red. You got the Dow up 59. The Russell up by 8. Regional banks trading higher, continuing the trend that they had on Friday. As we talked about, Bitcoin down almost $1,800 this morning. You got gold up by $4 right now. You have a bid in crude as well. And we jump over to the dollar index, 101.12, back to the lows of last week. So finishing up the conversation in this article. So again, right, when you look at what's happened during COVID, especially 2 years before the 9% peak inflation, the bond market was predicting deflation 2 years out, man. Is very difficult to talk about. Now, the next part to get about this, okay, is that you talk about the employment numbers, okay? What this gentleman talks about in this article, perhaps the most useful gauge, is the following, which shows the proportion of people between the ages of 25 and 54 who are in work. I'd say that's a pretty reasonable statement, man. Show me the amount of people in that 30-year segment, right, who are working. It rose steadily in the first 4 decades after World War II as women moved into the workforce. That epic social shift was broadly completed by the early 90s. You see that run up to almost 80%. And since that time, okay, when you had women joining the workforce being completed basically by the run up into 1990, the ratio has been higher than it is now for only a year or two. You're talking about the 2000 bubble, man, okay? You see the fall off during the pandemic. We're back above that level right now. Now, what's remarkable is when we were above that level, times felt good. It's not feeling like that right now, and I'd make that case for sure. The gig economy, man, I say, a job 20 years ago is not a job today. It's just not, man. The idea of employment 20 years ago, let alone 30 years ago, not a job that it is today. You have less benefits, no such thing as a pension, all of that stuff that usually goes with it, especially in the gig economy and as that goes forward. Now, the Fed has a mandate to maintain full employment, right? It's hard to see much of a reason to expect rate cuts from this because, man, we're at a level of employment that we've only seen for a couple of years higher since the year basically 1990 when we hit this level. So we have over 80% of people working in working age profile, which is basically above anything we've been at in the last 20 years. And even then, with the last 30 years, you're only talking about a couple of years. Unemployment's at 3.4%. It's just important to keep this stuff in mind, man, because the Fed may pause, okay? We'll see what the data does over the next couple months. But absolutely remarkable to talk about that you may get that level of cuts. Yeah, and they talk about the average hourly earnings in here. They talk about the CPI inflation numbers we talked about. Fed wants that back to 2%, man, okay? Wednesday is going to be an important number. He also looks at the National Bureau of Economic Research, what they consider when talking about where the economy is, as in do we need 5 cuts over the next 7 months? I mean, look at these monthly indicators to determine whether the economy is in recession, right? Look at them. Now, this is normalized to January of 2021, so we're 2.5 years later. Retail, real manufacturing and trade sales, the only one that's been chopping around. Everything else is still in an uptrend. Real personal income, industrial production, employment, real consumption, non-farm payrolls, just rocking higher, man. Now, COVID puts an asterisk with everything, and it makes it a little bit more difficult to do. They talk about the range we've been in the S&P, maybe 3,800 to 4,200. Yield's been chopping around a bit as well. And then what they get into is the banks. And how really this is a crisis for bank shareholders, okay? Now you have the FDIC covering, $13 billion for one of the banks. Was that Silicon Valley? But that's going to get covered by the big banks, okay? This is not going to cost taxpayers money. And it is different that it's just rate risk and duration risk. It's not actually getting paid. You hold it through duration, you will get more than what you paid for that if you can hold it for that long. It's a different kind of risk. Now, these banks deserve to fail because that's the business they're in, loaning money for an interest rate, and then they get deposits. But what they talk about here is, and this is talking about even Buffett in here, okay? But there's no panic as it would normally be understood. The Fed has hiked rates twice since SVB closed, and they've left themselves the opportunity to pause, okay? But number one, you have Buffett in there saying they're not going to let anybody lose their deposits. And I would agree, okay? But doesn't mean you should risk it, man, because the government is all sorts of defunct right now, and we got a debt crisis looming. And you want to be optimistic, man, but things are as divisive as they've ever been. We're coming into a presidential election cycle, and things are so close in Washington that it'll be interesting to see what happens. Now, what he does say in here that I really like, that I want to finish this up, and this is talking about Buffett, okay? Reason he's not interested in buying banks at the present. Or first bank, he has limits in terms of what he can do, how many banks he can buy. But he makes some great points here that he calls it a bank walk, right? I'm sure people have used that term. I've heard it. Not a bank run, but it's a gradual deal, and the pressure is on. And it's an eventual, it's a slow trickle, essentially, because there is so much competition for yield right now. I mean, I talk about it all the time, folks. I do a show called the Morning Market Report where I'm talking about trading. I trade options in my newsletter, and I can't help but talk about the risk-free rate of return right now approaching 5% over a 5-year basis. It's a staggering level of return that is risk-free when we have had no risk-free return for so long. And we have a lot of volatility, man. We have rates as high as they've been in a long time, and we have inflation still raging, and we have an unemployment rate of 3.4%, and we have month-over-month wages going up 0.5% in the last 30 days. Folks, you're supposed to have 2%. You do 4 months at 0.5%, and you're at 2%. We're a long way away. And COVID does make it different, okay? Because I think a lot of these companies, they just have such an opening, and it's going to be interesting to see what it takes for that opening to close. These companies have such an opening to raise their prices right now without being demonized. Because whose fault is it? Well, it's all of the stuff that's happened with COVID. You add in the politics of that, man. Very easy, depending on which side of the political spectrum you fall on, to either blame Biden or Trump. So it goes around and round in terms of the companies not seen as being the ones that are to blame because it's everything that's happened. And guess what? That just gives them the coverage to do it. I mean, what did Procter & Gamble do? Were they the ones that raised it 10% back-to-back years? They're selling less product. They're making more money. 10% price hikes on back-to-back years. Grocery bill's $100. It's $120 2 years later, and it's still going up from there. So with that in mind, man, it becomes very difficult to see all the cuts that are priced in here. And they just talk about, so the last thing Buffett does talk about here, if depositors are aware of higher returns elsewhere, then money will tend ex ante at the old deposit rates to leave banks, okay? It's going to raise returns for depositors via high deposit rates and thereby cut into bank profits, reducing net margins. So no matter what, banks are in trouble for a while, man. Short-term to medium-term, the hit to profitability and the sense of unease among bankers generally can lead to tighter lending. Yeah, well, of course, that's the case, but we have to see it in the data, man. You got to see it. Markets chopping around. S&P positive by 3. Stay tuned, folks. We'll go over some of the other equities. We're going to take a look at Tyson when we come back with their numbers.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The Gold Report. As a precious metal, gold is still king. It continues to hold the most effective safe haven and hedging properties across the global major trading hubs of the London OTC market, the U.S. futures market, and the Shanghai Gold Exchange. The Gold Report. Tom O'Brien publishes his weekly Gold Report every Monday morning for subscribers, consisting of coverage of the XAU, HUI, GDX, the dollar, bonds, the South African rand, as well as 25 different mining equities with specific buy-sell recommendations. The Gold Report. New subscribers get a 30-day money-back guarantee so you have nothing to risk. Subscribe to Tom O'Brien's Gold Report newsletter now at TFNN.com.
Will the S&P 500 continue to climb? For bold trades on U.S. large cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We got the S&P positive by 1 right now. Market's basically flat. NASDAQ 100 barely in the red. You get the Dow hanging on to gains up by 13 points. Yeah, so jumping over to Tyson. And people changing their habits, man. That's the first step, right? Down 12.6%. So to get into their numbers, plunges after cutting sales forecast amid high meat costs. You can't deny it, man. Meat's expensive. It seems like everything is expensive for sure, folks. But as is fruit is bonkers expensive as well. It's a tough one because you got to try and eat healthy, folks, okay? You can't just eat cereal. You know, it's just remarkable when you see the bills and then you look at the cost of goods that are very unhealthy, and we wonder why we have such a problem. Nonetheless, I digress. So Tyson, they're seeing revenue of 53 to 54 billion. They were originally looking for 55 to 57. The midpoint of Tyson's revised lower range is lower than the lowest of analyst estimates. Shares were down 10%. As I just pulled up, they're down about 12. One of the analysts out here talking about challenging protein market fundamentals and weaker than expected volumes mean adjusted operating margins in beef, pork, and chicken may get worse before getting better. And Tyson and other meat producers have been squeezed by record high cattle costs, elevated animal feed prices, just as inflation hit consumers, have been trading down to cheaper foods. So we'll see where that goes. Nonetheless, Tyson down about 12%. We jump over to Apple. They're going to the market with a $5 billion bond offering. The longest portion could yield 135 basis points over treasuries. So they're selling debt in the U.S. blue chip bond market Monday as a flood of borrowers look to raise cash before we get some CPI data coming out on Wednesday, playing their risk reward, getting in ahead of that data. It's going to be a 5-part deal. The longest portion is going to be 30 years, could yield 135 basis points. And man, what's going on with Washington right now? I'd say from a trader, you're more likely to get paid by Apple, which is crazy. It is. Now, they have treasuries. How does that compound things, right? What happens to all these companies that have U.S. treasuries who aren't going to get paid if we default? You almost don't even want to think about it. The dominoes would be so bad. Nonetheless, the fact you're getting extra yield over the numbers we're talking about right now, which are pretty good yield numbers, yeah, you can believe that people are going to be in high demand. As it says, the deal is going to be very well received by the market. This is some quote. Rob Waldner, chief fixed income strategist, head of macro research at Invesco. We have seen quite a lot of demand for high quality fixed income. Yeah, I'd expect so. And dealers surveyed by Bloomberg are looking for $30 to $35 billion of U.S. high grade corporate bonds this week. Pretty remarkable that they're going out to public like that. Yeah, Apple just thinks they can use the money for better. Yeah, they're going to use it for general purposes, they said in here as well. Where's that one? Proceeds from Apple sale will be used for general corporate purposes. That can include anything, man. Stock repurchases, dividends, working capital, capital expenditures, acquisitions, and repayment of debt. I don't imagine they're going to use it for repayment of debt because they probably have better rates wherever they are with their debt, but nonetheless. All right, what else do we got pulled up here? Let's see. What are we going to talk about? I had a couple good ones. What was I going to talk about? Talked about Tyson. Wow, we can take a look at Disney, because I was looking at that. Disney's rocking higher, man. They get an upgrade, I think, is what put them higher. They were up by 3%. They're up by 2.5 right now as the market All red. That was quick. Disney up by 2.5%. Morgan Stanley maintaining an overweight and bumping their price target to 115 to 120. Talking about cost cutting, I think I saw it somewhere in here. Let's see. Yes, on citing cost-cutting measures and overweight rating cap. Been quite a run for Disney, from 97 up to 103 on that Thursday run. But boy, in the long term, things just chopping around in the consolidation. Maybe this is the break higher, man. We haven't been at this price in terms of since about February. Early in the year, you were at about 115, 117, but you put this thing on a 3-year weekly, right? It's basically chopping around 100. You're at 102.91 right now. That's been the area you've oscillated around, and you back it up longer term. Pretty remarkable that you're at Disney prices that you were trading at 8 years ago, 8+ years ago of $100. That was after the run it had from 30 up to 100. Maybe you build the consolidation. I am a Disney bull, and I would say it's probably going higher, folks. Not a bad area to get into Disney when you think about the transition they've made to Disney Plus. That was not guaranteed, man. Okay, it's in hindsight, it seems so easy. All right, and Disney, there's no other brand like Disney, man. But that was not that easy in getting into the prices because, you know, Disney Plus didn't even start to materialize with a plan until April of 2019. And meanwhile, you're getting into prices below where you were trading at 8 years ago on Disney. And eventually, folks, they're going to be bumping out billion-dollar hits in the movie theaters again. Okay, I think in 2019, where is it, this year? That was the banner year, man. Now, COVID accelerated everything higher with everything, okay? But 2019, I think they had, I'll have to look it up, because it was staggering. I think there were 9 or 10 billion-dollar movies that year alone. I think Disney had 7 or 8 of them or something like that, and all the usual suspects in terms of the big Marvel movies or some Star Wars movies. I think it was a Star Wars movie in there. Well, that's coming again, folks, okay? Disney just announced they got some Star Wars movies coming down the line in, the next 4 or 5 years, right? They're just beginning production. So not a bad price getting in Disney at 102 longer term, I think, for Disney shares. Watch out for this market, man. We're down 15 points from where we were pre-market as we get a little bit of a slide to open things up from Monday trading. Coming into CPI on Wednesday, you see the companies getting ahead of that number, right? It's interesting that Apple doesn't want to play that game, man. Apple doesn't want to wait for rates to come down 3 or 6 months. They're comfortable where they are right now. They're not going to risk that coming into that inflation data. They're pushing that paper out today, not Wednesday or Thursday, looking for a CPI print on the low side. They're comfortable with the rates they're paying. It'd be interesting to see how the market comes into that number as well, to say the least, right? All right, what else do we have pulled up there? Let's see. Yeah, we talked about PacWest. Yeah, just bond traders talking about, yeah, this is a good one. Hedge funds face into bank turmoil with epic short, short treasury bets. I mean, we're talking about notes and bonds, but it's the basic logic we've been talking about the whole time, right? In terms of hedge funds are looking into the turmoil with epic short treasury bets, the leverage fund bets at odds with Wall Street U.S. bond bulls. So it's going to be interesting to see who wins here, because we got divergence of opinions as we get the market starting things off basically flat, down 2 points. We get the VIX right now elevated at 1769. Let's jump over to the gold contract, see what kind of action we got going on. Gold up $5 right now, 2029. Crude contract catching a bid, 73.08. The Fed's focusing on core inflation, but they don't want to see oil complicate things because that just hurts the consumer even more. Even though they have no control over it as much, it still matters, and it's still going to punish the consumer even more. Yeah, this story I found interesting. So this one's from the Journal. It talks about the Princeton Review and Tutor.com. They're now owned by a Chinese company. Tutoring brands with U.S.-wide contacts were quietly sold over a year ago. They had, what do they call this thing? Is it the CFIUS? What do they call this? The board that has to approve everything. I'll pull it up at the break, maybe. But it is interesting when you look at any company, and it gets so political, but it's acquisitions of private companies. And you look at a company like Tutor.com. They collect data on users. Okay, you got your name, your home address. They record every session that they do. So you're going to have all this data of tutor sessions between individual people. They're going to control all the data, and that's the Chinese government, man, just straight up. So I imagine that's going to be a bigger factor going forward, but those two did get approved. So nonetheless, it went through that process. Stay tuned, folks. S&P's down by 5. We'll be right back.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs, and join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We get the S&P kind of sputtering out of the gate here. We were coming in at pre-market session highs. We were coming in at the highs of Friday at 4160. We're trading right now down about 5 points, 4144 in the S&Ps. NASDAQ 100 rolls over to 13,264. Let's take a look at Apple. They're going to the public for $5 billion. They're down about 0.5% today. You take a look at Microsoft, man, quite a charge higher on Friday. There you go. That'll move the market, man. I mean, if you're trading these indices right now, folks, you got to keep your eye on Apple and Microsoft. What are they of the S&P? I think they might be like 12%. I should pull it up myself. But those two alone, even compared to the other FANG stocks, Apple and Microsoft, just staggering impacts on the NASDAQ 100 and the S&P as they move. So you got Microsoft selling off, down about 0.7%. We jump over to Google shares, up 0.25% for Google shares. You jump over to Tesla. Tesla shares up about 0.7. How about NVIDIA? NVIDIA down about 1%. Some of the FANG stocks out there. All right, we'll finish it up with Morgan Stanley's Wilson. So I've talked about this analyst for some time. Market's held up pretty well, man. But he still says the reckoning is coming. Take it for what it's worth. But it's talking about earnings as you go forward. Now, S&P 500 earnings per share at $195 is the forward estimate that he's looking for. And right now we're at about 226. Okay? So, yeah, you're talking about quite a drop is where you're looking for those numbers as we come through the year. Yeah, the boost to earnings projected by analysts is contingent on improving margins. We're more skeptical as labor costs continue to be a headwind for corporates, and our leading margin gauge points to additional margin downside and a muted recovery thereafter over the coming months. On top of that, slowing inflation means pricing power will fade for corporates. He added, look, I look at things as just a lot of pressure, man. You know, those core CPI numbers at 5.5%. Hold on to your hats on Wednesday, man. It's going to be an interesting week in the markets with inflation data Wednesday. We get it again on Thursday with the PPI. We have some numbers coming out, and you get the market sitting relatively well right now. Lofty levels when you look at 4,200 has been the upper boundary of this range. We're trading at 41.47. Thanks so much for starting your Monday off with me, folks. Stay tuned. We got our man Basil Chapman coming up next with the Tiger Technicians Hour. Steve Rhodes at 11. Fast Market at 12. Larry Pesavento, my dad this afternoon. Stay tuned, folks. Have a great Monday.